This video is part of a series of videos on tax tips for businesses for the end of financial year. And this one is about the instant asset write-off. So we're just going to talk about how does it work, why you should never buy stuff just for tax reasons, what's the limit for writing off assets, what if my asset is above the limit, and finally a little sort of side tangent on the ATO finally waking up to the incorrect ute write-offs. So how do these small business rules work? Well, with traditional depreciation, you split the cost of an asset over time. Like, for example, a motor vehicle is considered to have an 8-year effective life. And so you claim part of that vehicle over each of those 8 years. With the small business rules, they're simpler rules. You have faster depreciation. You're not getting any extra tax back compared to traditional depreciation. You're just getting the tax back sooner because the depreciation is faster. So if you get nothing else out of this video, don't buy stuff for tax reasons. It's such a common mistake of business owners, including sole traders. So there are only 3 good reasons to make a purchase for your business. One is to increase revenue. For example, you might buy a machine that enables you to do more work and generate more money from your business. Another example is to decrease costs. For example, you might be an allied health practitioner and you have a practice management software, and that helps you run your business more effectively, gives you more time to see more clients, and that's ultimately going to decrease your admin time, decrease your costs. Another example is the tax advice component of what we do as accountants. Tax is one of your biggest costs as a business. If we can help you avoid overpaying tax, that's a useful purchase. And the third category of costs is because you have to. ASIC fees, government registrations, insurance, and the tax return component of what we do is essentially red tape. So you just want to make sure that you're getting the money or you value out of the advice component, things like that. Bank fees is another example. But saving tax is not one of the 3 reasons. Here's an example of why. Say you purchase a $20,000 car, and let's assume it's 100% business use, so we can write the whole amount off. You get back the GST on that purchase, and if you're a company on a 25% tax rate, you get a quarter back of the ex-GST price, which all sounds very good, but of your $20,000, you're out of pocket $13,650. So it's still costing you. It's not as if this is a subsidized purchase. Take an example, maybe you're a health practitioner or a consultant and you purchase a laptop. You get the GST back, you get a quarter of the tax back if it's in a company. You're out of pocket $1,500. So if you're upgrading just to save tax, you're still losing. What is the instant asset write-off limit? Or it's $20,000. Bit of the fine print. Does it have to be a new asset? No, it can be secondhand. Do you have to adjust for private use? Yes. So you bought, say that laptop example, it's used 3/4 for business, but 1/4 for private use. You'd claim 3/4 of the cost. And that $20,000 limit, is that including or excluding GST? And it's excluding GST. So if it was 20,000 plus GST, you could still write off that asset. So let's talk about the rules for assets under and over $20,000, starting with assets under $20,000. Basically, the advantage of the rules, as I said earlier, is you can depreciate the asset in full, which means the cost doesn't get split over multiple years. It all goes in your tax return in the year of purchase. It's based on the ex-GST price. And so when you're budgeting for a business purchase, you just factor in the GST and the tax you'll be getting back to show the true cost. And I'll run through that with an example to explain that a bit better in a second. The GST is straightforward. It's 10%. It's on the invoice. What about the amount of tax you get back? Well, if you're a company, it's straightforward. It's 25% flat rate of tax. for a small business. If you're a sole trader, it depends where you are in these tax brackets. Let's pick one as an example. If you're in the middle tax bracket, 45,000 to 135,000, you're getting back 32%. So 30% tax, 2% Medicare levy. What if you're not a company or a sole trader? Let's say you're a partnership or a trust. Those sorts of entities don't pay their own tax. They distribute the money out to the partners in the case of a partnership or the beneficiaries of a trust. So the amount you're saving depends on how much tax that person would otherwise have been paying. So I don't think these rules are good for encourage you to buy assets, but I think they're helpful to work out the real cost of an asset, right? So if you go shopping, you look at the price and you say, yep, that's worth it, I'll buy it, or no, that's not worth it, I won't buy it. It's pretty straightforward. With a business purchase, we're going to look at the price, adjust for the fact that some of that's coming back in tax, and decide if the after-tax price is worth it or if the true cost of that item is worth it. So I'll give you an example. So you take your purchase price. If you take off the GST refund and the tax refund, that's the true cost to you after tax. So let's go back to our laptop example and say it's a sole trader buying a laptop. We're going to get back 10% GST. That's $200. And then of the 2,000 that's left, we're going to get back 32% tax. So the true cost of that laptop is $1,360. So you wouldn't say, is it worth paying $2,200 for this new laptop? You would say, is it worth paying $1,360 for that new laptop? So what about if an asset's over $20,000? Well, we do what's called a depreciation pool. So in the first year of purchase, you claim 15%, and in the later years, you claim 30% of what's left. Why 15% in the first year? Because you haven't owned it for a full year. So in traditional depreciation, you work out how many days of that year you held the asset. So if you buy it in August, you've held it for nearly the whole year. If you bought it in May or June, you've held it for only a small fraction of the year. So things you buy early in the year have higher depreciation and later in the year has lower. These rules are simplified, which means you get to claim 15%, so half. So it's as if all your assets were bought on the 1st of January, like halfway through the year, and then 30% after that. So let's do an example to make that make more sense. So say you've bought some equipment for $55,000. That's 5,000 of GST and 50,000 of the actual cost. So it's the 50,000 that we get to depreciate. The 5,000 of GST just comes back to you on your BAS. So what would that look like? So year one, it's 15%, year two, 30, but it's 30% of what's left. See 42.5. So then it's 30% of what's left. End of the second year, you've got 29 left. So next year it's 30% of that. And then end of that year, you've got 20,000 left. So it's 30% of that and so on. So it gets lower and lower each time. At the end of the fourth year, you'll notice the balance is below $20,000, which is our write-off limit. So what do we do then? Well, if your closing pool balance is under the instant asset write-off limit, which is 20 grand, you can write off the balance of the pool. But does that mean it's 20 grand after we claim depreciation or before? Well, the ATO website clears that up. And I've got the search reference there if you search that number. Basically, you deduct the balance of the pool after depreciation. So what would that mean in this scenario? That $14,000 for the next year, instead of taking 30% as our deduction, we just claim whatever's left as an amount. Now, this write-off rule applies to the whole pool. So say you're running a business where you had multiple machines of over $20,000. It would only be if the combined value of those got under 20,000 that you could write off the rest. This example assumes that this company only has one machine above $20,000. So that's how our higher value assets work. Timing wise, The asset must be, this is an ATO quote, first used or installed ready for use by the end of the financial year to count in that year. So if you order a car on the last weekend of June, but it gets delivered on the 2nd of July, technically the depreciation will start in the following financial year in July, the delivery date. And while you shouldn't buy assets you don't need, you are better off buying in June than July because you get the deduction sooner. I should say you're usually better off buying in June and July. Sometimes you're in a situation where you have other deductions that your income's low enough already, or you're a trust where you're distributing to a low income beneficiary. So it's not that crucial to reduce your income because your taxes isn't that high in the first place. But all things being equal, or if you're running your business in a company, not a trust, you're better off buying in June than July. And that's true even for our high value assets. The reason why is because let's say we bought the asset in the 2026 financial year. That means we get our 15% depreciation in the 2026 tax return and then 30% depreciation in the 2027 tax return. If we'd waited until July, then we get nothing in our 2026 tax return. We've bought the machine in July 2026 and we get 15% back in 2027. So we're a year behind. So in summary, if you bought the asset in June, by the time you do the 2027 tax return, the government's given you back $5,000 in tax breaks. But if you buy the asset in July, by the time you do the next two tax returns, you've only got $1,800 back. So again, it's a timing advantage. You're not getting more tax back in this scenario because you're eventually going to get the same tax back in the other scenario. You just have to wait longer. But cash flow is important. If you can get the tax back sooner, why not? Always pays to defer tax if you can. So what about if you sell an asset? If the asset was originally written off, whatever you sell it for is then income. I'll show you why in a second. If the asset was in the pool, there's a way to adjust the balance of your asset pool if you're to sell it. So when we think about selling an asset, again, we want to think about the true proceeds from selling an asset. If you sell something for $5,500, but you're paying GST and you're paying tax, that's the opposite of before. So of your $5,500, you only end up with $3,750. And depreciation wise, let's say you bought something for $20,000, but you wrote it off to zero with instant asset write-off. So you've depreciated it down to $0 of value, but actually you sell it for $5,000. So it turns out that item didn't have zero value, it's got $5,000 of value. So it really only cost you $15,000 in the end. So the reason why the sale counts as income is because that means that the deduction and the income, if you subtract those two from each other, ends up being $15,000, which is actually what it cost you to own that asset because you got some of your 20,000 back. So it sounds like it can surprise people when they sell an asset, they've got to pay tax on it. And that's because they've already depreciated it in another year. I'll talk about the ute issue, but what I might do for now is just to sum up on the asset write-off stuff because that's not relevant to everybody. And I'll just put that as a little side note at the end if you want to stick around. So what's the summary of this? The main thing is to make business purchases for the right reasons. So it's increasing your revenue, decreasing your future costs, or because you have to, not for tax reasons. Secondly, assets purchased in June attract more deductions than July, but it's only a timing advantage. As a business owner, make your purchase and sale decisions based on the true cost of an asset after tax, because that's what it really costs you, not the ticket price. So that's all about instant asset write-off. Stick around if you've got a business that owns utes and you're not sure you're on the right side of the ATO rules. Other than that, I'll see you in the next video. Thanks for your time. So for those of you interested in the ute thing, just because it's a ute doesn't mean you can claim a deduction for it. And you don't so much have a depreciation problem or an instant asset write-off problem. You have a fringe benefits tax problem if the ute's owned in a company or trust, or an apportionment problem if you're a sole trader. So here's our trader. He's saying if it has a tray, it's A-OK, i.e. all utes have better tax treatments than cars. The ATO says if it's a car, the answer is nah. The reality is the type of vehicle matters and the use of the vehicle matters. Let's talk about the type of vehicle. If you want to see this in more detail, because there is more fine print to this, go to the ATO website and search 71130. So single cab utes, use the typo, single cab ute is included. Some dual cab utes are included. Vans, buses, taxis, and others are included. Passenger vehicles are not eligible for FBT exemption, and you can't claim them as 100% vehicles as a sole trader. Dual cab utes carrying under 1 tonne are not eligible for this, with a few exceptions that apply. So this is an ATO letter, so it hasn't got any client personal details on it, but that's an actual letter that you could get from the ATO, and they've taken the example of a Ram 1500. So I'm not a petrolhead, but I searched what that looks like, and it's one of those massive American trucks that hogs parking spots and lanes, but anyway, or American style, I should say, utes. And see, importantly, it's a 4-door ute, so it's got the passenger seats in the back as well. The ATO, it's obvious that people are going to be using that on the weekend. They're going to have the car seats in the back for the kids, or it's much more likely to be a recreational vehicle if it's a dual cab or 4-door ute. So that's the kind of thing the ATO is actively looking at now, which they've ignored for decades. But yes, desperate times, budget deficits and all that stuff, they're finally going after people. So it wasn't like this is a new rule. This is just them enforcing an existing rule that they've ignored before. So myth number 2, you can use your work vehicle however you like. So I said before, the type of vehicle matters and the use of the vehicle matters. And our ATO guy is saying, if it's not used for work, you don't get the perk. What do I mean by that? The ATO website is clear that a work vehicle has to be work use to be exempt. So if you want an FBT exempt ute, not only does it need to meet the criteria, it needs to meet the use, which is travel between home and work, travel that's incidental to travel in the course of employment duties. So you stop by the shops on the way home from work, you drop the kids off on the way home from work, on the way to work, I should say. And non-work related vehicle that is minor, infrequent, and irregular, such as occasional use of the vehicle to remove domestic rubbish. So they'll let you do a couple of tip runs in a year, but you can't take it on holidays. You can't use it as your daily drive. You can't take it to the footy. There was this urban myth back in the day that the ATO used to go out to the MCG when there were big games and look for utes with company logos on them and like, oh, FBT audit, but I'm pretty sure that's apocryphal. But yeah, if it's your private car and your work car, don't claim 100% of the costs essentially. So dual cab utes, am I saying don't buy a dual cab ute and buy a whole separate car just for carting around the kids and the family? No, you can still buy a ute with an under 1 tonne capacity, and you can use it as a passenger car, but you can't then use this 100% exemption. You would need to keep a logbook of the business versus private trips and work out your FBT that way. And for all utes, if it's both your work and private vehicle, you'll need to apportion for private use. And again, a logbook's the easiest way to do that. So that's our little warning about utes. If you've got an old ute that's purely used for work, I've got clients who've got an old bangers of utes that might even just stay on the work site, or all they do is go to and from work and they're not used any time on the weekend. No problem, you're still fine. So hopefully that helped. And if you're still here for the Ute part, once again, thanks for your time, and I'll see you next time.